Marissa, we're going to give people like a couple more minutes and then jump into things.
That sounds great to me.
Okay, awesome.
Where are you based, Kat?
I'm based in New York City. How
Oh,
about you?
nice. Very cool.
How about you?
I'm normally in San Francisco, but today I'm up in Sac visiting for my dad's 60th birthday. So a little
Hey,
celebration, a little work.
that's awesome. A good balance. I
Yeah.
love it. I love it. Yeah, most of the Catalent team is in Boston, which is where our headquarters are, but I'm here in New York with a couple of other folks.
Awesome.
All right, people are trickling in. Do you want me to get started here?
Let's go.
Okay. Great. Well, hi everybody who's joined so far. For anyone who I haven't met, I'm Kat Adams. I'm Catalent's Director of Community Strategy and Operations. I'm going to very briefly kick things off today. It's really the collective team's show, and they'll take it from here in just a moment. But I wanted to kind of just share kind of some quick context from the Catalent side of things and why Catalent is doing partnerships like this one. As you all know, because you're part of Catalent, Catalent has focused historically on providing one thing to independent consultants, which has been project opportunities. But we also know that there are a whole host of other things that independent consultants need. That could be project related support, that could be support related to managing your business, like collective. And we believe that Catalent is in a position to help. So one way that we are doing that is by actually having partnerships with third parties, again, like Collective, to provide solutions to some of the things that we know you need or challenges that you face. And one of the challenges that we hear about very frequently is all things financial management as an independent. We know that it's really time consuming, it's not billable hours, it's quite complicated as an independent. Which is why we're really excited about this partnership, because Collective is focused on making all of those things easier, but specifically for independents. So I'm not going to go into it any further than that, because that's why the Collective team is here. So I will pass things over to Marissa. Over to you.
Thank you, Kat. Welcome. Good morning, good early afternoon to everybody. I know most of you are on the East Coast, so welcome. Really appreciate you sharing your time with us. We're going to talk about what Collective does, super high level, really focus more on the education, what challenges, deadlines, opportunities do self-employed people face, and how does Collective work into that if we're the right fit. We're going to spend a short amount of time on a presentation style, 10, 15 minutes on the front end, and then we're going to turn it over to you and ask for some participation. Use the Q&A feature within Zoom, and we're going to field questions and just have a live discussion. So if that works for everybody, we'll get started. Throughout the presentation, there are these QR codes. So if you feel like Collective is the right fit for you and you want to talk to somebody, you can just scan the QR code. It'll take you directly to book a call. But we'll dive in. So a little bit about me real quick. I've been with Collective for over 3 years. I came from old school public accounting. So I was a tax accountant in a cube with a box of receipts and people's QuickBooks files. And I had no life during this time of year. So I took a leap of faith and pivoted to a startup. And here I am 3 years later talking about taxes. So a really great parallel or a connection there. But I'm glad to be here and share what I've learned in the tax space and how it applies to self-employed people. Let's get this slide going. So again, we're going to talk about Collective, some upcoming deadlines. Maybe you're aware of some of them. What happens between federal and state tax obligations, what to look out for, some high-level tax strategies for self-employed individuals, and then we'll pivot over to the live AMA. So Collective, quick refresh. Some of you have maybe heard this pitch before, maybe not. Really, the idea behind Collective is we're an all-in-one solution specific for single-owned businesses, specifically those who want to be taxed as S Corps. So we are a solution for all things bookkeeping, payroll, business tax filing. You've got a team of accountants and tax experts in the background to support you as you navigate self-employed taxes. This webinar is for education, so we'll just keep it specific to the questions that apply to you as we move forward. And key deadlines. So we are in tax season. I'm not going to read all of these, but we're in the thick of it. The IRS opened the filing season at the end of January. So by now you should have received 1099s. If you're on W-2 with another employer, you should have received that by now. If you've got an S Corp or a partnership already established, the next deadline coming up is March 17th to prepare and file or extend business tax filings. And then the one everybody knows about, it's on Super Bowl commercials, April 15th, deadline to file or extend your personal tax returns. So if you don't have those on your calendar, now's a good time. So self-employed tax season tips. We're going to keep these super high level, and then I'll leave it to you to put the detailed questions in the Q&A. We're going to start with understanding federal versus state obligations. So if you self-prepare, if you have a CPA, maybe this isn't super top of mind, because usually when you go to generate a tax filing, it's going to automatically populate your state data. If you're new to self-employment or you're new to having an S Corp, keeping this in mind is critical, because if you trigger a business tax return, it's not only going to trigger a federal filing, but state filings as well, both on the payroll side, maybe sales tax is something that's part of your business, as well as state business obligations. So just being aware that there's going to be a state component to this new business filing is something that we want to share. The names of the tax forms will be different. So if you file a 1040 for federal, don't look for that word on your state filing. It might be something different. A lot of states follow or piggyback federal tax deadlines, which makes it easy, but sometimes they don't. So if you're using a self-prepared software or a CPA or collective, we'll make sure that you're aware of any differentiating deadlines or extended due dates between federal and state obligations. Failing to know when your deadlines are can mean maybe filing things late or not filing at all. So understanding that these deadlines may be different can keep you ahead of late filing penalties. Pro tips, we don't need to talk about this too much. Putting it on your calendar is something that'll help you navigate tax season. If you're a collective member, we push all these notifications to your collective dashboard. And I'm not looking at the Q&A right now, so bear with me. If you posted anything, I will get to it, I promise. All right, so let's pivot over to some high-level strategies for self-employed. The first and best advice that anybody can give you, collective CPA, somebody who's done taxes for a long time, is you want to lower your taxable profit. So this has to do with understanding what deductions you're entitled to take for the nature of your business. The IRS says you can deduct anything that's considered ordinary and necessary to generate revenue for your business. So something like keeping clean financial statements, maybe a separate business bank account, will really help you isolate what's actually deductible for your business, give you visibility on where there might be opportunities. So deducting that business profit, capturing all the deductions, lowers what you're taxed on. So that's the first and best advice that we can give. Next, if you're setting aside money for retirement, considering tax-deferred retirement plans, what this means for a tax-deferred plan is you get a deduction, a write-off in the year that you contribute to one of these types of plans. We typically see a SEP IRA for people who are set up in like a Schedule C, so you're a sole proprietor or a single-owned LLC. A SEP IRA is usually the tax-deferred retirement plan that will let you maximize retirement contributions while giving you a deduction in the year that you contribute. We often see that people switch to a solo 401k or a more traditional 401k plan when they graduate to the S Corp status. Again, this offers higher contribution limits, which means more that's deductible in the year that you contribute. And then you pay the tax when you take the money out at retirement. We touched on this briefly, but keeping accurate records. So bookkeeping, maybe right now it's an Excel spreadsheet, maybe it's Wave, maybe it's Collective, maybe it's QuickBooks. But maintaining these accurate records will help, one, Keep your documents and your transactions clean throughout the year, so that when tax time hits, you're not scrambling like I've done for many clients in the past to come up with a profit and loss number. It'll also help you make decisions on where you can reinvest in your company. So if at the end of Q1, your profit's real high, maybe it's time to reinvest into some marketing, because you've got big growth goals. So having clean data can help you make those decisions. When you've exhausted the deductions you can take, your profit is what it is. Now it's lowering, how can I reduce my cash flow issues? How do I not pay a ton at year end? So this is where this concept of quarterly estimated taxes come in. This is just prepaying into your tax bill throughout the year. So when you're self-employed, contrary to a traditional salaried role where you have withholdings, money taken out of every paycheck, when you're self-employed, there's no means to withhold. So the IRS and your state will want you to pay into your tax bill throughout the year. So implementing quarterly taxes can help with a cash flow perspective, not necessarily reducing your tax bill, but it'll help maybe prevent some PTSD April 15th when you have to pay your taxes. It won't be a huge amount. And what to consider when you've exhausted all of these options. Maybe you're service-based, you work from home, you're selling your brain power, your talent, your expertise. There's not a lot of overhead costs. And this is where most of collective members fall. They're providing a service, and so they've exhausted everything that they can write off. Now it's time to reconsider your tax status. And so this is where collective has expertise. We specialize in the S Corp pass-through taxation. It's a tax selection that's layered on top of a legal structure. So if you've got an LLC or a legal corporation already set up, this S Corp tax status can be layered on top. And what does it do? The S Corp, let's see. The S Corp, in short, really helps you reduce and control how much you pay in self-employment tax. And so if any of you are set up as a sole proprietor or single-owned LLC, sole proprietor means there's no legal entity formed. Single-owned LLC means you're the only owner of an LLC that you formed in your state. Under that structure, you're what's considered a disregarded entity for tax purposes, which means you and your business are one taxable unit. So all of this business activity is included on your personal tax return. It's on a form called Schedule C. And what this means is your tax filing is relatively simple. You only file one return every year. An Excel spreadsheet is suitable so you can report a profit and loss statement. The downside is how you're taxed. And so under this reporting structure, you're paying a couple layers of tax. One is your income tax rate. So this is based on your filing status. If you file single, head of household, married filing joint, that's your tax status. And then within each of those tax statuses is your tax rate, income tax rate. And so your income tax is determined based on your total household income and your filing status. So your spouse's income, if you've got a rental property, some gains and losses from investments, all that's factored in to determine your income tax rate. That's assessed at both the federal and the state level. Then when you're self-employed, structured as either sole proprietor or single-owned LLC, you pay self-employment tax, which is made up of 12% Social Security and 3% Medicare for a total of 15%. This graph is a little bit flipped, so we will fix that before we send out a copy to you. But the Social Security is the 12.4%. This total 15% is assessed on your entire business profit. And so profit is the amount left over after your deductions, which is why we want to back out as many deductions as we can to lower our taxable profit. But the self-employment tax, 15% assessed on your entire profit, in addition to the federal and state income tax. So self-employed individuals can find themselves paying 3 layers of tax on the entirety of their business profit. And so if you've been self-employed reporting on Schedule C, I'm sure many of you have encountered the self-employed tax bill. So what does the S Corp election let you do? Again, as a refresher, it's an election that goes on top of a legal structure, so on top of your LLC, which means an LLC would need to be formed first. And when you add the S Corp tax election, it's going to tell the IRS, one, you're agreeing to a more complex tax profile. You trigger a separate business tax return that needs to be filed. You need more comprehensive bookkeeping. You need both profit and loss and a balance sheet. And you have to pay yourself a reasonable salary. So this means setting yourself up on payroll. It's a lot of work. It's a lot of administrative work, but the benefit is that when you elect S Corp status, you put yourself on a salary. Then only that salary is subject to that additional 15% of self-employment tax instead of your entire profit. So in this slide, we've got the two examples, the two structures that you could be in. The left side is if you're structured as a sole proprietor, single-owned LLC. And in this example, somebody's earned $160,000 of business profit. Under their tax structure, that entire 160 would be subject to the 15% self-employment tax, resulting in nearly 25,000 in self-employment tax alone. If that same individual added an S Corp election to their LLC, they would be required to pay themselves a wage. And so in this example, that wage is $60,000. Then only that 60,000 instead of the 160 would be subject to the self-employment tax. So that's a reduction of almost $15,000. Prem, what happens to the additional 100? I'm going to answer this one now since it's super topical to this slide. This total 60 and 100,000 between owner wages and owner distribution is still your total compensation as the business owner. The 60,000 wage is the portion that you will continue to pay self-employment tax on. The remaining 100,000 can be distributed out to the owner. All that means is you can initiate a transfer from business checking to personal checking. And this is the portion of your income that's skipping self-employment and is only subject to income tax. So your total compensation is still the 160. You're just receiving it in two buckets. One bucket's a wage subject to all the layers of tax. The other bucket is only subject to income tax. And so that's the advantage of S Corp, is it'll let you control and reduce that self-employment tax burden. Now the downside is the administrative burden. So what happens when you trigger this separate business tax return? It could just mean that, one, you can DIY it, you can file the election, and then you piece together a bundle of different services. So this visual is showing like what would you need to do to accomplish and meet all the compliance requirements of S Corp if you did it yourself. You would separately need a either self-prepare or a CPA to prepare and file a separate business tax return. You would need a bookkeeping solution. So maybe it's a QuickBooks subscription plus a bookkeeper to maintain the books for you. And then you need to layer on a payroll provider. So feasible, technically doable to do it yourself. Then it's coordinating different fees, platforms, maybe doing some of the work yourself, doing a lot of research. Where the idea behind Collective is if this route's the right fit for you, we can tackle it under one platform. So the pro of S Corp, opportunity to reduce self-employment tax. The downside is the administrative burden goes way up. That's the end of my little spiel. I hope that was informative. We can get into the nitty gritty. I know there's some great questions already in the chat in the Q&A. And we can get more specific here. So please, Kat, any commentary or feedback you have so far before I dive into Q&A?
No, I would say I just love that the questions are coming in. So let's jump to the questions that people have.
All right, well, here we go. I'm going to dive in. If you've put questions in the chat, I am not going to look at those, but please put them in the Q&A and we'll go from there. All right, I'm just going to go for it. Kunal, thank you. If I open an LLC in 2025, do I have any tax submission deadlines in calendar year 2025? No. The only implication you may have is paying quarterly estimates on the income you earn under your LLC. But the first filing period, you're within tax year 2025, which means there won't be a tax reporting period until 2026. Let's see, Bart. Can you keep earnings in your LLC S Corp for future investments without paying taxes on it in the year where they were received? No. So whether you take money out to reinvest in the business or leave it in there as profit, it is considered income in the year that you earned it. And then if you took it out to pay for an investment that you will own personally, it would still be considered current year business profit because it would be an owner distribution or money used for you personally, Bart, to invest in something else. So you would have to pay tax on the income earned. Why is there a cutoff at 60,000 for considering S Corp status? Won't it be helpful at a lower amount to anonymous attendee? That's a great question. So you can be an S Corp, you can elect S Corp status with any profit level. You could have a loss and have an S Corp. Really what most people are looking for when they opt to research collective is a tax savings opportunity. And so $60,000 is an arbitrary threshold of the point at which the savings potential of an S Corp will be more than the cost to do the extra work. And so there could be some added value to an S Corp without a relation to savings. Maybe you need to put yourself on salary, or maybe you're looking into a small business loan and you need financial statements and separate tax data. Those are opportunities that exist, and the S Corp can still benefit you without a savings piece. So $60,000, it's not a rule with the IRS. It's really just the point at which you might see savings after paying for all the extra work. What is the definition of a reasonable income, Darren? That is a question that we get all the time. So reasonable wage is a condition of having an S Corp and maintaining compliance. The IRS is very vague. The tax code says it literally needs to be considered reasonable based on facts and circumstances. So there's no formula, there's no equation to determine your salary. It's very arbitrary. The things that we want to consider in your salary are: where do you live? Are you committing to this part-time or full-time? What's a comparable salary if you were to go to LinkedIn with your seniority and experience and education level? Then when you're the owner of an S Corp, you're really considering, what hat are you wearing? So as a business owner, you wear many hats. Marketing, business development, actually performing the service. And so the reasonable compensation component is supposed to cover your role as performing the service, not as the business owner and acquiring new clients. Which I know that could feel like a non-answer, but that's because the IRS gives us a non-answer. It's very vague in the tax guidance. There is an unofficial rule that if you were to Google how to come up with reasonable compensation, you might stumble across the 60-40 rule, where it's a 60% salary allocation, 40% distribution. That's not vetted by the IRS. It's just a vague breakout of how you might separate the wage and the distribution, but you want to consider your role title, where you live, in determining that. And then the salary is flexible. So if you have a lull or you're taking time off, you can skip payroll. Really what the IRS is looking for is an annual target. In the example of 160 LLC versus S Corp, it says S Corp owner wages 60K, 100 distribution. What is generally considered safe, not triggering IRS audit? Again, so very much in parallel with the last question. When you determine your salary, I would say it's best practice to document how you arrived at that conclusion. Maybe it's year one of your business and you've only got one contract, so your salary would reflect a lower volume of activity. And then as you progress, you give yourself a raise, just like what would happen in a traditional salaried role. So documenting how you arrived at your conclusion, it's very, determining your salary could be a very personal decision. Maybe your risk aversion factors into this, because in theory, the lower you pay yourself, the more you save, because that's less you're paying in Social Security and Medicare tax. But you don't want that salary to be so low that it triggers the audit. I would say most of collective members fall within 30 to 60% of their profit as the salary allocation. And that's just going to depend on where their comfort level is as the taxpayer. If you were a candidate and you joined collective, these are conversations that you could have with your account advisor. Just do a gut check, like, am I on track for my growth? If something changes halfway through the year, you can adjust your salary at that point. So there are a lot of opportunities throughout the tax year to do a pulse check on where your salary is going to land. But if you're making 200 grand a year and your wage is $10,000, that won't fly. Don't recommend. Bart, does collective have all the same electronic connections to investment banks and institutions? Like, we don't, Bart. I'm sorry to say we don't have all the same supplemental services right now, but we're building it out. So Collective is still very much a startup, very much supporting single-owned S Corps, a very niche service, but we are building out our partnerships with referrals. We're working on having a lot more of these additional services integrated into your Collective experience. Where we're at right now in our growth stage, there's not a whole lot of integrations, but a lot of partnerships. So nothing but opportunity there on that front. Jason coming in with the hard questions. Can you talk about whether you lose the qualified business income deduction if you elect the S Corp? The easy answer is no, you don't lose it, but there are a lot of factors that determine whether or not you would actually get a QBI deduction. The first line of defense to determine if you're even eligible for a write-off for QBI is your total taxable income. So the IRS establishes all these various thresholds to determine if you phase out of a certain kind of deduction, and QBI is one of them. So for example, if you file single and you make more than, and I don't know the threshold off the top of my head, but let's say it's 200,000 in a year. The tax code could say if you're single, if you file single over 200,000, you are ineligible for QBI altogether. So depending on your earnings, you may not get QBI at all. You are eligible for a QBI deduction, whether you have an S Corp or single-owned LLC, or you operate as a sole proprietorship. But those other limitations may factor into it. When you elect S Corp status, it triggers these additional phase-out rules related to QBI, where normally the eligible QBI deduction is based off of your net income. But when you switch to S Corp, it's still based on your net income, but it can be limited to what your salary is. So what you pay yourself out of the S Corp. So there are these layers of how it's factored in to determine what you would get as a deduction, depending on how you're structured. But even before that, to see if you're even eligible, you have to decide, am I falling within an income range that allows for a QBI deduction? So you don't lose it, but there's more factors to consider in the phase out and the limitation. Dirk, can I make the S Corp election at any time in the year, regardless of how long I've been operating as an LLC? So first, you need to have an LLC in place in order to elect S Corp status. That's the foundation, that's the legal structure underneath. So if you've got an LLC, you have the ability to backdate the S Corp election. Typically, the IRS wants you to elect, for an election to be considered timely, you need to make the election within 2.5 months of the start of the tax year that you want S Corp status to be effective. So if you wanted it for 2025, you need to technically make the election by March 15th of this year. Anything done after that would follow the IRS's late relief process, which just means you fill out the same form, but it's a little bit more complicated. And then you have to do some catch-up work, like consider retroactive payroll to make sure that reasonable salary components met, make sure you get your books rebuilt if you're not using an accounting solution. So there's some catch-up work to be done, but if you have an LLC in place, you can technically backdate your S Corp election to a current tax year. Going back further, I would say is more challenging because when you have an S Corp election, one, it could trigger some late filing S Corp tax returns. You wouldn't have the payroll component, which can be super messy. You might have to amend some personal tax returns. So typically don't recommend going back multiple tax years to elect S Corp status just because of the fallout and the catch-up work and the amendments that would need to be done. But if you're thinking about 2025, yes, you can do that. Megan, what is the right time to set up an LLC and add the S Corp election? What happens if you do it at year end and have been sending all the business income into your personal checking? So there's kind of phases that you can operate, and maybe this context will help. When you're testing the theory of being self-employed, like maybe you're straddling a W-2 salaried role, but somebody offered you this contract job and you're thinking, okay, this could be cool. I've never been self-employed before. I don't know if I'm going to like it. When you're testing the theory, I would say we see people stay a sole proprietor, which means nothing's formed. So this sounds like where you're at, Megan. So there's no legal structure in place. You're just receiving income directly to your social security number, which is totally fine. Let's say you've proven the concept, like you like self-employment, you're organically getting these leads. Maybe your salaried role is offering to pay you to an LLC and things are aligning. So you've proven the concept and maybe you're more committed to the self-employment path. That would be the point where I see most people setting up the LLC at least. Because what the LLC is going to do is it's going to give you a legal business name, a tax ID, so you're not sending out your social security number, and it's going to set the foundation to elect S Corp status in the future. So you don't necessarily have to do the LLC formation and the S Corp status at the same time. The instance where we see most people do an LLC ahead of S Corp election is when maybe their profit isn't guaranteed, like they're pending a couple contracts. And so they're not sure if they're going to hit that threshold where the savings advantage of an S Corp will cover the cost. I would say if you've proven the concept, forming an LLC sooner than later will be the best bet. If you know that you're going to continue in self-employment and you've got over 60,000 of profit locked in, you can do it all in one fell swoop, LLC and S Corp election at the same time. What happens if you do it at year end and have been sending all the business income into your personal checking? So if you form an LLC at year end, what it means is for the whole of the year, you're going to be taxed as a sole proprietor, which means you're kind of locked into that self-employment tax structure with all the layers of tax. When you form at year end, it's most likely that you would elect S Corp status for the start of the following year, right? Because you don't want to file like a 10-day S Corp tax return. So anything that happens prior to an LLC being formed will be stuck in that sole proprietor, federal, state income tax plus self-employment tax bucket. Serge, can you still have a defined benefit plan with S Corp? I'm going to level with you. I don't know the answer to that question. Let me find out. And if we can provide some resources in the post-webinar email, we can get you an answer. I'm not an expert in the financial advisory world, but let me find out the answer to that. You've got great questions and I keep scrolling and I don't think I'm halfway through. So if y'all have time to hang on, we can hang on for a little bit. Angela, I already have an LLC. Is it too late to elect S Corp status for 2025, given that I haven't run payroll? Yes, you can still retroactively elect S Corp status to the start of the year. If your LLC was formed prior to January 1, 2025, your S Corp can be effective 1/1/2025, so a clean start date. It's not too late in the year where maybe you have to consider a catch-up payroll, but if you would like to, once payroll is set up, you can do a one-time payroll catch-up run and then set it up on a more routine cadence for the rest of the year. What's the process for transitioning to an S Corp? So it's actually it's like a 2-page form with the IRS. It's called Form 2553, and it's going to show the name of your legal entity. So Angela would be the name of your LLC, your EIN, the address on file, your desired S Corp election date, which would be January 1. You sign it as the sole owner of the LLC, and it's submitted to the IRS. That's something Collective does for you. So we vet it's filled out properly, so that when the IRS sends their confirmation letter, we know that there won't be any like rejection points. But it's a 2-page form. It's relatively easy to make the election. What's complex is the compliance that's needed after. So it's submitting an election with the IRS. Depending on your state, you may have a separate S Corp election that's involved, but if you are interested in Collective, that's something we can help you through as well. What is the lowest amount one can give owner wages? Seems like the idea is a lower self-employment taxes, so one would keep it as low as possible. There is no what's the lowest amount. Very facts and circumstances based, and it is true, the lower you pay yourself a salary, the more you save. But failing to meet whatever the IRS defines as a reasonable salary can result in the IRS assessing a salary for you. And then they assess that payroll tax and penalties and interest anyway. So the risk of paying yourself none or too little is that the IRS can redetermine for you and you get hit with that same tax bill anyway. Again, this would be what's your risk aversion? Like maybe you're paying into Social Security and Medicare with another role already. And so you have comfort in having a lower salary through your S Corp. That could be a decision that you make. Facts and circumstances. So consider where you live, how much time you're spending on this role to determine the salary. You only pay yourself a wage of $1,000. Dwight, unfortunately, I would say no matter how much you're making, a wage of $1,000 probably won't cut it. So again, facts and circumstances, the risk that you run is really considering what's the risk and are you going to roll the dice? So the risk is that the IRS could redetermine that salary for you and then hit you with the back tax bill. Does Collective Platform also include a business accounting solution like Wave? Yes, Collective Accounting is included into your membership. So it's accounting software very similar to Wave, QuickBooks, Xero, where the business bank accounts, credit cards connect to the accounting software. They talk to each other, import all the transactions live. And then you also have a team of human bookkeepers who are categorizing and putting things in the right bucket so that we can publish financial statements. All of this is included in one login, so your Collective dashboard, so it's all under one interface. You as the member have the ability to, attach receipts, put in comments related to what client this transaction is related to. That's not required, but some folks are more hands-on, so that functionality is there if you like it. We have invoicing integrated into your Collective platform, so if you use QuickBooks for bookkeeping and invoicing, in theory, Collective would replace both. Katie, if you distribute wages that are higher than the max amount of Social Security, let's see, for which Social Security are taken out, then incremental benefit of it is reduced. Yes, so what Katie's asking is that if you have, let's say you're a high earner and your reasonable salary is going to max out the Social Security limit. So for context, self-employment tax is made up of 2 different taxes. Medicare tax, 2.9%. It's not capped, so you can have Medicare tax assessed on any amount of earnings. Social Security tax is the bulk, it's 12%, but it's capped at, and I think the limit this year is 176,000 of wages. So the IRS will assess Social Security tax on up to 176,000 of earnings. If your business is making $500,000 a year, your reasonable salary will likely be beyond that Social Security limit, which means you're paying the most in Social Security tax. So the S Corp advantage would mean you're only saving in Medicare. You're controlling the Medicare tax portion already. So that's correct, Katie. Depending on how much you make, that could still be a substantial amount. That's 3% on maybe $300,000 of profit that you would pay Medicare tax on otherwise without the S Corp. So there's still opportunity there. Jen, can you use Excel for bookkeeping, or does it have to be something like QuickBooks? If you're reporting on your personal tax return, where it's that Schedule C, you have to consider what's your tax compliance requiring you to report. So the Schedule C, the simplest version of being self-employed, is just a profit and loss statement. An Excel spreadsheet would probably be sufficient for that if you're going to stay there. If you elect S Corp status, highly recommend not using an Excel spreadsheet because you now have to report both a profit and loss and a balance sheet. If there's any accounting nerds in here, the accounting equation is assets equals liabilities minus equity. All that means is that these two financial statements are a big equation, and there's ins and outs and gives and takes, and they work with each other. So tracking a balance sheet and a profit and loss through an Excel spreadsheet is doable. I've done it, but it's not fun. Where software like QuickBooks or collective accounting is automatically going to balance the equal and opposite transactions that happen to generate those financial statements. And again, those are critical when you elect S Corp status because they get reported on a business tax return. What if you already have an S Corp set up? Is your business a good candidate for collective? Yes. If you have an S Corp set up and assuming it like meets the criteria that we're built for, single owned, service based, we can take over the maintenance of your S Corp. So we would continue with your bookkeeping, migrate your payroll into the Gusto subscription that's included in your collective membership, and we would take over preparing and filing your business tax return. When you pay yourself in the example, let's see, how are we on time? It's 11:43. How are folks doing? We've got 35 people still on the call. I'll keep going. And if you want to hang on, if you got the time, I'll be here. So I'll just keep going. When you pay yourself in the example, 100,000 distribution, is that taxes at ordinary income rates or is it taxed at a different rate? Jason, so that $100,000 owner distribution, that's your remaining business profit taxed as ordinary income. So your ordinary income rate's gonna, be based on filing status, total household income. It's ordinary income. Thank you for joining, Kat. We will record and we'll see you next time.
Thanks, Marissa. Thanks, everybody. Shoot me an email. I put it in the chat if you have any other questions for Catalan or for any reason you need follow-up. But thank you for collective team. Thanks, Marissa.
Absolutely. Bye. All right, we're gonna keep going. If y'all are still cool with hanging with me, we'll keep going. Jason, I hope that answered your question. Ordinary income for the remaining business profit. If you have a part-time employee, can I elect solo 401k? So solo 401ks are specific to a single owner. And it could be a husband and wife, or it could be your spouses. So solo 401k is specific to single owner spouses. If you add employees, it would just be a regular 401k plan where you still capture the advantage of deferred investments. So you pay the tax when you take it out and you get a deduction in the year you contribute. Super high level with the 401k plans. The advantage one is the higher contribution limits. The second is who's contributing. So when you run under a 401k plan, you can contribute as both the employer and the employee. The employee, so you as the owner, can contribute up to whatever the IRS threshold is for this particular year. I think this year it's 23,000. And there's no like wage limit or profit limit on that. You as an employee can flat out contribute 23,000. Then your S Corp can make a matching contribution of up to, I think it's 25% of whatever your salary is. So between the employee and the employer contribution, you could end up with the ability to contribute a higher amount, which means potentially a higher tax deduction. That went super left field from your question, anonymous attendee. But in short, if you've got employees, you would most likely switch to a regular 401k versus solo 401k. If I bought a laptop and an office in 2024 and opened an LLC in 2025, then could I count those expenses towards my LLC for tax year 2025? I need to do some research on this question because it came up recently. Usually there's a way for you to write off startup costs. In this instance where you invest in your company prior to a new tax year starting, can you write it off? Let me get back to you because there's a couple ways that this can happen. Startup costs can be depreciated, meaning you capitalize them and then you take a deduction over time. Usually, we're cash basis taxpayers when we're set up so simple, which means you get a deduction and you recognize income within the tax year that it happens. With startup costs, I think there's some nuance there. So let me find out the answer to that. Short version is you'll be able to deduct it. It's just when, which tax year. Tamara, is there a downside of going straight into a solo 401k as a single owner LLC? Oh my gosh, I'm sorry that I'm going to say I don't know to two questions in a row. As a single owned LLC, technically, I know there's a way to do it. I'm not sure if the solo 401k as a single owned LLC lets you do both the employer and employee contribution limit. And it's because when you're set up as a Schedule C, most thresholds are determined on your Schedule C profit instead of like a salary, like a wage. And the solo 401k, some of those limits are tied to whatever the wage is being paid to the salary or to the owner. So Tamara, let me find an answer for you. I'm sorry, I don't know. What about trade-offs with SEP IRAs or 401ks? CPA advice against an S Corp, even though we're above 150 in profit and just 1099. So SEP IRA versus 401k, the main difference is who gets to contribute. So I think we touched on this briefly. SEP IRA, it's all an employee contribution. So one person or one unit is contributing. And the threshold is based on 20% of your business profit. So if you made $100,000 in profit as a Schedule C reporter with a SEP IRA, the maximum you could contribute is $20,000, 20% of your $100,000 profit. If that was structured as a 401k under an S Corp and you had 100,000 of profit, this is going to be too mathy to just speak to it, but you could do as the employee 23,000 flat out. And then let's say your wage was 50,000. You could do another 25,000. I'm sorry. Don't make me do math without a calculator. You could do 25% of your wage in addition to that $23,000 employee contribution. So it's expanding who can contribute, and in turn, it can expand how much you can contribute. If your CPA is advising against an S Corp, look, I come from old school accounting. At my firm, we liked to work on really big clients, and maybe this is something that self-employed people encounter often is too big to DIY yourself, too small for a traditional accounting firm, which is where collective can fit in and meet in the middle. Maybe your facts and circumstances don't mean S Corp makes sense. Like if you have a high earning salary beyond your 150 profit, maybe you've exhausted the Social Security limit, so it's limiting the savings potential of an S Corp. It also could be that your CPA doesn't want to do another tax return. So that could be part of it. Maybe collective is a solution that over a CPA. What is the general rule of thumb for deducting mortgages, interest, and phone and laptop depreciation? So anonymous attendee, you're talking about like home office deduction. Yes, if your home office is your primary place of doing work, so you're a remote worker, service-based, you don't go into an office, then you can deduct a portion of your home office expenses. So really you combine mortgage, property tax, rent, internet, phone, utility bill, total all those up and apply a percentage, and that's what becomes deductible. Determining the percentage is going to be like, what's the square footage of your home office space divided by the total square footage of your home? That becomes a percentage that's then applied to those expenses. I would say most people probably fall within like a 20% range that gets applied to those deductions, and that's the deductible portion. Laptop depreciation. So if you have any piece of equipment, like a singular piece of equipment that's going to cost you over $2,500. This is an IRS tax code thing. Any single piece of equipment that's over $2,500 needs to be depreciated, which means you deduct the cost of a certain expense over time instead of deducting it all at once. Most laptops will probably be under $2,500, which would mean you just write it off like a normal business deduction. If it's over, then you would depreciate it, and there's no, like if it's 100% business use, there's no limitation. You would just depreciate it and take the deduction over time. We encounter this a lot with like the photographers we work for. Maybe some people have work vans or vehicles. So depreciation is something that's totally allowable if you're LLC, no entity set up, or S Corp. It's 11:51. I'm going to go to the top of the hour and we'll see how far I get. If I missed your question, I'll make sure that my email is in one of the docs. You can find me on LinkedIn and we can touch base. But I think we're getting towards the end. How does retained earnings kick into the picture of reasonable wages versus distribution? Ooh, okay. We talked about the profit and loss in the balance sheet being an equation, right? These financial statements balance each other out. They work in and out of each other. Retained earnings is part of owner equity, which is a balance sheet item. Reasonable wages are a profit and loss item. They're a deduction for your S Corp. And so, oh gosh, without getting like too granular, reasonable wages factor into your profit. They reduce your profit. Profit increases your retained earnings. Distributions decrease your retained earnings. So if you've got retained earnings of 100,000, that's your starting balance for 2025. And your business profit, so you've written off your reasonable salary, your business profit is 60,000. That increased my retained earnings to 160. Then let's say you took a distribution of 20,000. Now your retained earnings is 140. So it's a plus or minus of different equity transactions. Profit is one of them. Distributions, if you put money back into your business, that increases your retained earnings. And so it's a plus or minus of all these different equity factors. Profit, which factors in the reasonable wage because it's a deduction, and then distribution contribution. Without getting too gross and taxi, I hope that answered the question because we could go down a rabbit hole with that. Fast forward to when I'm retired. What is the impact these decisions will have on how much I can get in Social Security? For instance, if I paid myself a 60,000 wage versus 160 as an LLC. So this is something that comes up often. If you pay yourself less in Social Security, does it mean you're eligible for less when it's time to take money out? I'm not great at speaking to this, but we've got a great article that we can put in the post-call email. Basically, the way Social Security is calculated in short is like you get points, I think. Depending on like how much you've contributed, you get points that factor into like a payout base. And so if over your lifetime you're hitting these certain like thresholds, then you could be like maxing out your Social Security regardless. I'm going to stop there because I'm not great at speaking to it and I need to practice it, Tamara, but we've got great resources. I think on the IRS website, you can also see what you've paid in year to date. If you've already paid in a ton to Social Security, there's a chance that maybe you're already maxing out the potential payout. And so maybe switching to S Corp, depending on how far you've contributed, will have minimal impact to your future payout. It's something to be considered, but the way that it's determined, I think in short, it may not be super material, but it's going to depend on your facts and circumstances, how long you've been contributing to Social Security. So we'll include that article for this group in the email at the end. Can you pay a salary irregularly? Project-based, yeah. A lot of our members, there's a seasonality or a flux to when they receive income. It's project-based or commission-based. Most of our members that are set up in this structure will set up like a monthly payroll cadence, so it's less frequent. And then you could skip as needed, and then you can run an off-cycle payroll as needed. I would say setting up a cadence is probably a good idea because every time you you run a payroll. It's going to remit the withholdings, submit Social Security and Medicare, any state withholdings. You generate payroll tax returns, both federal and state, every quarter. And so you might have heard some people pay themselves a salary at year end. Not, I'm so sorry. I have housekeeping trying to knock on my door. This is so unprofessional. I'm so sorry. That has never happened to me before. I'm really sorry. I'm traveling for my dad's 60th birthday, so I apologize. I'm in a hotel. You can pay your salary irregularly. So setting up on a cadence will help you stay on top of quarterly filings, making sure that you're paying into that reasonable salary. And if you need to run an off-cycle payroll, then that is totally fine. Is the $30,000 to $60,000 guideline based on income or profit? Based on profit. So income, gross, that could refer to like just your straight revenue, what you bill your clients. If you are earning profit, that is usually where the salary is determined. As an independent consultant, cash flow may not be constant. Is it okay to take wages at year end? Yes, so you can have inconsistent payroll, paying a lump sum at year end. Some people will do this. The IRS likes to recoup payroll taxes throughout the year. So I would say if you don't want to do it on a regular cadence, maybe even quarterly is something that you can do. They don't dictate a cadence for your payroll, so it can move with the flux of your business. Is there any difference I need to make to how I pay my health insurance or my contributions to Simplified at S Corp status? Does the company need to do it versus me as an individual? Anonymous attendee, let me get back to you. I don't know where the money needs to come out of. In short, regardless of where it comes from, you will get a deduction for it. If it comes out of personal and it should have come out of business, there's an accounting solution to that. But let me get you the firm answer. I don't know if there's a best practice there, but either way, in either instance, you still are eligible for the deduction. Can you switch to S Corp after the year starts, like in March or April? Yes, as long as you have an LLC in place or a legal foundation in place, you can add the S Corp status at a later date. Depending on when you make that decision, you could fall under the IRS's late relief process, which again is just a more complicated way of filling out the S Corp election form. But as long as you have an LLC in place, it opens the door for an S Corp election. Which is why if you're operating as a sole proprietor, you've proven the concept, you can reasonably expect over $60,000 of profit. In the very least, getting an LLC set up is probably a good move because it's going to set the foundation for electing S Corp in the future. I'm going to do one more. It's 59. So let's see, Kevin. Once you've pulled the trigger on S Corp, imagine 2 years down the road, you jump back into enterprise role and stop independent consulting for a couple years. Is it best to drop the S election and park the LLC or keep it active somehow? So you have the ability to revoke an S Corp election. The downside is that when you revoke it, you default to a C corporation, which is the structure that has the true double taxation. So it pays a corporate level 21% tax. And then you as the owner pay tax again when you take a dividend. So if you revoke the S Corp election, you default to a C corporation. You've got to fill out another form to revert back to the single owned LLC, which is totally doable. Further, if you do that, if you do the revocation, then you're prohibited from making the S Corp election on that same entity for 5 years. So I would say if you're parking it or it's less activity while you go back to enterprise, you can keep it open if you're going to come back to it. If it's unsure and you don't want to be on the hook, you don't want to run the risk of missing filing obligations, maybe you dissolve the whole thing. And then if and when you're ready to restart, it's a new LLC with a new S Corp election. But there are some barriers with revoking an S Corp election. And if you park it and you're not sure when you're going to come back to it, you run the risk of missing, even if there's zero activity returns, it's still a trigger on the IRS that could prompt the IRS to revoke the S election for you. If it's minimal activity that will still happen on the side of your enterprise role, maybe you keep it open. Maybe you figure out a cost-effective way to keep it open with less activity until you're ready to come back to it full time. There's a couple questions. Well, there's not a couple. There's a lot of questions left that I didn't answer. So I'm going to stop there. If I did not get to your question, I apologize, but super appreciate the activity and the conversations and the great questions. There are no bad questions here. This is complicated stuff. So I super appreciate the activity and the responsiveness of this group. If you're interested in booking a call with our collective team, our advisory team is on standby. They're waiting and they're ready for y'all. So if you want to book a call, scan this QR code. Our information, you can find me on LinkedIn. We can catch up there. 1 month free with the Catalent discount code. Again, really appreciate the participation here. And we're excited to meet with you guys again.